Hey everybody, I'm Joe Killinger. I'm a real estate investor and entrepreneur, and we put these videos together every week to give you all the tips and insights from my experience over the last several years. So make sure you tune in and subscribe. Hey everybody, thank you for tuning in. Several months ago, I did a video with George. Actually, I suppose I should introduce you. George Pino, Commercial Brokers International. You've seen the other videos with him. You're kind of old school now, so I don't think you can say
I feel like this chair is mine.
Yeah, exactly. But we did a video about 1031 exchanges, and people have really started reaching out and asking different questions about the timing on a 1031 exchange and just the different aspects of it. So I asked George to come back in and really walk us through the different aspects of, the timing, all the guidelines and all that to get all these answers. So George, thank you for coming back in again. Such a long drive, huh?
Very long drive today, and as always, thanks for having me.
Yeah. The video, people really liked it, but they did start reaching out in the comments, like actually coming even direct and asking questions. Yeah. So instead of doing it one at a time, let's just put the video together and get it out.
The timing is actually, the timing of a 1031 exchange is probably the most confusing or for a lot of people and a lot of investors on the first time exchange. And even people who have done exchanges before may not be aware of some of the rules and guidelines. Everyone always hears 180 days.
And like for like.
And like for like. And like for like can also be, that can be confusing too as well, because it doesn't mean that like for like in the sense of I'm selling an investment house, I have to buy an investment house. Right. It's real estate for real estate. So you can look, as long as it was an investment, not a primary residence or a secondary residence, then you can be eligible for the 1031. And but the timing that's always come up, and what everyone seems to understand is 180 days.
Right.
Now, in exchange, you do have 180 days to close the escrow, but there are also other hard time frames, and these are hard dates. Doesn't matter what may have happened or what happens on the day that it occurs. These are hard dates. So, and it's from the date of the sale of your down leg or the property that you sold until you purchase your up leg.
Okay.
So the other hard date is 45 days. Now, most people know that, understand or see it, but they don't. It's not 45 days to close escrow. It's actually 45 days to identify the property that you're going to purchase for your up leg. So those.
Now you can identify. Isn't there something, if you identify a certain amount of properties, you have to buy all of them?
Yes, there's a 3 rule, and then there's a 4 200% rule,
okay,
or more than 3 200% rule.
Okay.
So if you identify up to 3 properties,
right,
you can purchase any or all of them, or one of them, or 2,
right,
and it could satisfy, depending on the price points, it could satisfy the exchange in whole. The 200% rule, which is very rarely used, is you can identify 5, 6, 7, 10 properties, not just 3. But they can't be in aggregate more than 200% of the value of the property that you sold.
Okay.
And you have to purchase all of the properties, which is the biggest risk. So, if you identify 6 properties, you have to close on all 6. If you don't,
that's one that a lot of people aren't aware of.
It can put your entire exchange at risk. So that's something to be wary of. And very rarely do we see that. We typically see the 3 property rule, where someone identifies 3 properties that is either going to, either going to be the entire exchange or parts of it are going to add into it, and they'll purchase 1, maybe 2 of them.
Right.
The time frames, the one time frame to remember though is that you do have the 180 days to close, but one little small, and almost nobody knows this except for the true exchange experts, and those are your accommodators. But there's a rule actually with the IRS that it can be shorter than 180 days to close escrow, and the rule is the earlier of either 180 days from the sale of your property, or the date you file your taxes.
Okay.
So especially now in this time of year, when we're going into November and December, if you sold your property in December, you'd have typically until June to actually close escrow. However, if you file your taxes on April 15th, or 17th for 2020, since it falls on the weekend, you're going to actually be in violation of your 1031 and lose it if you don't close the property before then. So the nice part is IRS understands that you should have that 180 days. You can actually file an extension.
Okay.
But the coordination happens when you're not talking to your team player. So everyone's talking to the accommodator, everyone's talking to the broker.
Right.
A lot of people don't talk to their tax accountant ahead of time. So they have to let them know.
Depressing people.
Yeah.
That's all.
Well, but they need to let the accountant know that, you know what, I sold this property, I'm in the middle of an exchange, I can't do my taxes yet. What I can do is we need to file an extension, and then when we close escrow, I can actually file the taxes.
Okay.
So that way it doesn't invalidate any of the 1031 guidelines, you're all in the clear, and you're good to go. The other option, of course, is, you know, you can always do a reverse exchange.
Yeah. Buy it first.
Absolutely.
You should walk us through that. Go ahead.
Oh, well, all right. Well, a reverse exchange, we do have a couple clients that do this. You know, the biggest problems with exchanges, a lot of people have concerns regarding, if I sell my property today,
What am I going to buy?
what am I going to buy to replace it? Now, depending on what type of asset or asset class you're in, that's either very easy or can be very difficult. If you're very particular and you want, you know, if you're only looking for multifamily property that is not under rent control in Southern California, that was built after 1987 but before 1990, it could be hard to find a property. Now you'd be concerned. So the other way to do it is that you can actually purchase, you know, there's two parts of components to a 1031 exchange. There's your down leg, which is the property that you're selling. And then you're going to have all the capital gains on.
Yep.
And then the up leg, which is the replacement property. So the reverse exchange, which is not very common or very commonly known for that matter, is when the investor actually purchases the up leg first.
Yeah.
And although they're purchasing it, it goes to a third-party intermediary, typically the accommodator. They hold it in a special title for them, and then they sell. They now have the opportunity to sell their property.
Is it the 180 days as
It
well?
is. They have, but the nice part is they've already found the property, so they can now sell their
Okay.
property. As long as they're realistic in the price,
Right.
it shouldn't be a problem, especially in a hot market. And that's really the main reason when to use a reverse exchange is in a hot
Is there a
market.
penalty if you, let's say you've got your up leg in and you're putting you're going to be selling your property. Is there a penalty if you don't close it?
No
Tying
penalty.
that other property up?
No penalty, but you do own another property.
Yeah.
So it could be, well, which is, you know, for some people, if it was a good investment, you know,
As long as they can afford to close it.
as
yeah.
long as they can afford to close it, absolutely. So,
Okay.
and a lot of people can. You know, there are other opportunities that they can potentially do as well to acquire and move assets around. And, you know, that's where you want to really consult and have your team in place, not just your broker, not just your attorney, but your accommodator and your CPA all on the same page.
Yeah, yeah. Who do you see as the most widely used? I mean, I hear the agents that I know that talk, and, you know, they're calling on a lot of multifamily. They're calling people that have owned these properties for 30 years and, you know, there's no depreciation left. They're moving them into triple net typically around the country. Is that the most widely used on a 1031 exchange? Or what class is typically? Do you know?
We see a lot of that for the Southern California market. I mean, I think the class is open to just about anything. We see a lot of land, especially right now, where people have owned land.
Okay.
And now it's being, you know, it was investment land, farmland, and we're seeing it starting to get interest from developers as the areas expand. So the value of the land has gone up dramatically. They're going to be hit with a very high capital gains on it. Or you see it where in California, some of the land is now in cannabis zones where they can grow.
Right.
And so the price of the land has tripled or quadrupled.
Yeah.
So you see some of those families now looking to sell that
Exchange it.
and exchange it into actual brick and mortar, not just land investments that we're bringing in some income, but
different asset
looking
class.
for assets and asset classes.
Okay.
You also see clients that are selling multifamily homes that are getting a 2-3 cap in the Southern California marketplace and essentially increasing or doubling their income by going out of state and finding properties at 5.5, 6 caps with corporate guarantees. And you know, the interesting part that we always run into when it comes to investors, and why you want to make sure that you have a really good team of people advising you, is that a lot of investors, when they have bought a property, they may have paid $100,000 for it, and 20 years ago, and it's now basis is nothing, but it's worth $2 million now. They think they're doing really well.
Right.
They may only be netting, or they may be netting $50,000 or $60,000 a year, and they think they're doing really well.
Yeah.
But when you look at the actual return on the equity that they built up, and that $2 million, it's really only about a 3% or or less. And you can usually find a property that they can exchange into, increase their income. The last property I just did for a client of mine in this situation, we increased the income by over 36%.
Well, didn't you just have one
So-
where a lady sold her house in a nice part of LA and then you put her back east somewhere?
We actually diversified the risk by putting into properties. We had a investment home that was a very high income area and
Okay.
very high price, and we're able to increase the basis by purchasing a little bit more. We purchased 2 assets, both of them in the 5+ cap rate range, where they were at the home was generating after tax and her expenses probably about a 2% NOI. So we're doubling income right there.
Yeah, a lot of people don't think like
yeah.
that. You've got this asset sitting there that could really be generating a lot more money for you and your family. So, all right, we're probably getting a little long in the tooth here. So, George, thank you very much for coming in. Thank you for tuning in. And if you haven't done so, please subscribe, and I'll see you again next week. Thank you.